Mastering Fundamental Analysis. Your path to smarter stock investing. Imagine this. It's 2008, the height of the financial crisis. Millions of Americans watch helplessly as their retirement savings evaporate overnight. Homes are foreclosed, jobs vanish, and the stock market plummets like a stone. But amid the chaos, a savvy investor named Warren Buffett steps in. He buys shares in companies like Goldman Sachs at rock-bottom prices, not because of hyper trends, but because he dug deep into their fundamentals. Fast forward to today, and those investments have multiplied exponentially, turning fear into fortune. What if you could do the same? What if, instead of gambling on the next meme stock, you armed yourself with the tools to spot real value in the market? That's the power of fundamental analysis. And today, I'm going to show you how to harness it. Buckle up, because this isn't just about numbers. It's about securing your financial future and the peace of mind that comes with it. Friends, let's be real. Investing in stocks can feel like an emotional roller coaster. The thrill of seeing your portfolio soar on a good day, the gut-wrenching panic when it dips. I've been there, staring at my screen during the 2020 COVID crash, heart pounding, wondering if I'd lose it all. But fundamental analysis changed that for me. It's not some dry academic exercise. It's your emotional shield against market madness. It turns fear into confidence, doubt into decisiveness. For everyday Americans like you, teachers saving for college funds, entrepreneurs building nest eggs, or retirees protecting their hard-earned wealth, this is the key to investing with heart and head aligned. So what exactly is fundamental analysis? At its core, it's the art and science of evaluating a company's true worth by examining its financial health, business model, and economic environment. Unlike technical analysis, which obsesses over charts and patterns, fundamental analysis asks, is this company built to last? Will it thrive in good times and survive the bad? It's like dating. You don't just look at the surface, you dig into character, stability, and potential. And in the USA, with our vibrant markets like the NYSE and NASDAQ, this approach has created legends from Buffett to Peter Lynch. Let's break it down step by step, starting with the foundation, financial statements. These are the report cards of a company, filed with the SEC, Securities and Exchange Commission, for transparency, a hallmark of American capitalism. First up, the balance sheet. This snapshot shows what a company owns, assets, owes, liabilities, and what's left for shareholders, equity. Picture Apple Inc. Their balance sheet reveals billions in cash reserves from iPhone sales, low debt, and massive equity. But if you see a company like a struggling retailer with mounting debt, that's a red flag, stirring that uneasy feeling in your gut, reminding you of past bubbles that burst. Next, the income statement, your window into profitability. It details revenues, expenses, and net income over a period. Emotions kick in here. Joy when revenues climb, like Tesla's explosive growth from electric vehicles disrupting the auto industry. But watch for red ink. Consistent losses can evoke the dread of watching a dream fade. Key metrics: earnings per share, EPS, which tells how much profit each share generates. For a USA audience, think of Amazon. Their EPS has skyrocketed as e-commerce boomed, turning early investors into millionaires. Yet, during tough quarters like post-pandemic supply chain woes, a dip in EPS might make your heart sink, urging caution. Then there's the cash flow statement, often overlooked, but emotionally reassuring. It tracks actual cash moving in and out. Operations, investing, and financing. Why emotional? Because profits on paper mean nothing if cash is drying up. Remember Enron? Their profits were smoke and mirrors, leading to one of the biggest corporate scandals in U.S. history, shattering trust and lives. Positive free cash flow, like Microsoft's consistent billions from software subscriptions, gives that warm glow of security, knowing the company can pay dividends, buy back shares, or weather storms. Now, let's layer on ratios. These are your emotional barometers, quantifying health in digestible bites. Start with valuation ratios. Price to earnings, PE. A low PE might signal a bargain, igniting excitement like finding a diamond in the rough. Google's parent Alphabet often trades at a reasonable PE, given its ad revenue dominance. But a sky-high PE like some tech startups, can trigger anxiety. Is it overvalued hype? Debt ratios like debt to equity measure risk. High debt evokes fear, reminiscent of the 2008 Lehman Brothers collapse. Profitability ratios such as return on equity show efficiency. Buffett loves high ROE. It's like a company's emotional IQ, indicating smart capital use. But fundamental analysis isn't just numbers, it's about the bigger picture, stirring deeper emotions. Consider qualitative factors, management quality. In the USA, we idolize visionary leaders like Elon Musk at Tesla, whose tweets can swing stocks, but whose innovation drives passion. Yet scandals like those at Wells Fargo erode trust, leaving investors feeling betrayed. Industry analysis matters too. Is the sector growing? Think renewable energy amid climate concerns. Investing in solar firms like First Solar can feel empowering, aligning with values and hope for a greener future. Economic moats, Buffett's term for competitive advantages, add emotional depth. Patents, brand loyalty, network effects. Coca-Cola's moat is its iconic brand, evoking nostalgia and reliability. Without a moat, companies face erosion, like Blockbuster versus Netflix, a tale of missed opportunities that tugs at regret. Macro factors tie it all together, especially for Americans navigating Fed policies, inflation, and geopolitics. Interest rates rising, growth stocks suffer, stirring caution. A strong economy boosts consumer stocks like Walmart, fostering optimism. During the 2022 inflation spike, fundamentals helped spot resilient firms like Procter & Gamble, whose essentials weather storms, providing emotional stability. Let's pause for a real story. My uncle, a factory worker in Detroit, lost big in the dot-com bust of 2000. He chased hot tech stocks without fundamentals, feeling the sting of betrayal when they crashed. Years later, he switched to analyzing blue chips, like Johnson & Johnson. Johnson, solid dividends, ethical practices. Now retired, he sleeps easy, his portfolio a testament to patience over panic. That's the emotion, from despair to empowerment. You can feel it too. Practically, how do you apply this? Tools abound for USA investors. Free SEC Edgar database, Yahoo Finance, Morningstar. Start small. Pick a stock like your favorite brand, say Starbucks. Analyze their 10K report, annual filing. Calculate ratios using Excel. Join communities like Reddit's R Investing or Motley Fool for insights. But always verify fundamentals yourself. Pitfalls? Emotions can betray. Greed ignores overvaluation. Fear sells winners too soon. Behavioral biases like confirmation bias, seeking data that fits your hopes, can blind you. Counter with discipline. Set criteria, diversify across sectors like tech, healthcare, energy. In conclusion, fundamental analysis isn't just strategy. It's emotional intelligence for investing. In a world of volatility, from AI booms to election uncertainties, it grounds you. Remember Buffett, invest in businesses any fool can run, because someday a fool will. For you, the USA dreamer chasing the American dream, this is your toolkit. Start today, feel the shift from anxiety to assurance, and watch your wealth grow not by luck, but by insight. What are you waiting for? Grab that stock ticker, dive into the fundamentals, and turn your financial story into one of triumph. You've got this, because knowledge isn't just power,